Ladies and gentlemen, good afternoon. I'm very pleased to open this afternoon session of this very comprehensive one-day conference, and I would like to thank the organizer for inviting me. We will have two panel sessions. The first will discuss the investor protection, and the second will deal with the ever-evolving trading landscape. So, as we all know, the European Commission has released in July details of its long-awaited consumer protection initiative. And it's a package of directive intended to counteract the destructive effect of the crisis on consumer trust in financial institutions. Its ultimate goal is to embed customers' interest in the delivery of financial services. And the launch of this consumer protection package could not have been more timely, to be honest, since it coincided, as you may remember, with revelations that retail investors were likely to be the big losers in the latest bailout of Bankia, which was the failed Spanish bank, if you remember. So retail clients were sold €3 billion worth of preference shares, while the product was marketed via bank branches as very liquid and as safe as a deposit. So indeed, came as a shock, as a surprise to say the least, when the EU bailout terms indicated that these retail investors would lose everything and would rank behind senior bondholders. So the latest proposal on investor protection by the Commission come in the form of a trio of directives. You have PRIPS. I don't know if we still have to talk about PRIPS. We'll see that later. It's really now, it really comes down to KIT now. IMD2, and you have UCIT 5 and 6, in even 6 now. So the first directive is the Package Retail Investment Product Directive, which was intended to apply a UCIT-style treatment to all complex and packaged financial services, including the retail structured products that I like and that I teach my students at Louvain, Mons, Paris, and Lille, and to value. And I can tell you that I have some awesome examples of, I would say, scandalous deals, right, to show them. Let me just show you one example that was initially provided to me by Jean-Marc Michelet. Of course, no name. This structure note is actually an insurance investment structure note, which gives you 2 guaranteed coupons of 4% a year after the first 2 years. It's also callable at year 3 without being too technical, but you will see, and onwards. And it gives you a performance equal or greater than 5%, right? So if you do not have any monthly cap on this product, on the performance, it's really nice. You know, you have this graph. I like this graph. When I have to teach my students, I typically use this graph. I don't know if the regulators will use this kind of graph. We'll see. But this graph gives you the payoffs, the expected payoffs. So on the x-axis, you have all the simulations, right? 1,000 simulations in this case. And the blue line is the internal rate of return. So what do we see? We see that we can reach an internal rate of return of close to 40%. Right, so it's capped, and you may have a loss. You may have a loss of, let's say, maximum 12%, right? And so you make money. The break-even point is the blue line crossing the x-axis. You make money in 90 cases out of 100. So it looks nice without the cap, the monthly cap. Now, if you add the monthly cap, so if you just add a feature to the product, you see this is the expected payoff. So you do not make any money. So you have one single case out of 1,000 where you will make positive money. So you see, you have to be very well advised when you deal with this kind of products. And this is precisely to help these investors that We're trying to separate the wheat from the chaff by designing a robust methodology at my home university to value these products. Having said this, let us go back to the PRIPS directive. So PRIPS is, in its current form, very much focused on the KID, right? That is the key information document that will be probably discussed during the panel session. We will also discuss whether PRIPS fully addresses all the key sales and disclosure issues for retail investment products. The second directive, right? The second directive is, let's see, is IMD2 here. And this is a revision to the Insurance Mediation Directive. As you may know, the goal of this directive is to provide consumers with the same professional standards of advice, regardless of whether it is offered by the insurance provider itself or by a third-party intermediary. This directive seeks, in particular, to address the conflicts of interest involved in the financial services sales process. I know that we have people from the insurance industry in the room, so it would be nice to have questions from people from the insurance industry today. So the third and final initiative, recent initiative, is another UCITS directive, UCITS 5, which sets out regulations and administrative provisions in respect of depository functions, right? Remuneration policies and sanctions related to UCITS. And the latest UCITS 6 focuses on securities lending and repos, OTC derivatives, as well as liquidity and systematic issues regarding ETFs and money market funds. Right? So it's complementary to the Commission's work on shadow banking. So during the panel session, we will probably raise the following questions. Will Europe be a safer place for investors with those directives in place? What will be the overall result? Will there be any unintended consequences? What can we expect from PRIPS and the KID, right? During the second session, I don't know if I have to introduce the second session right now, but I think so. During the second session, we will look at the future of the trading landscape. So there is another trio of regulation pieces that are still hotly debated these days. You have EMRR, you have MiFID II, and MED II, and you have also the regulation, so the regulatory counterpart, MAR. The European Market Infrastructure Regulation, EMIR, is Europe's answer to better regulating the over-the-counter derivatives markets. It focuses on post-trade clearing and settlement requirements through central counterparty clearing houses. And the key question is how to make sure that the systematic risk in the CCP, so central counterparty clearing houses industry, remains manageable. The second pillar is MiFID. As you know, MiFID I broke the grip of established exchanges on trading and opened the way for alternative trading venues, thus increasing competition and driving down trading costs for investors. MiFID II, on which there has been a vote in Econ late September, if I'm correct, has a different job, right? So it sets out to shift trading from the OTC market, the over-the-counter market, to more transparent and organized markets, right? And also attempts to do a technological catch-up, updating the original MiFID to take account of new potent technological challenges, such as the advent of high-frequency trading and algorithmic trading. So today, HFT, high-frequency trading, is thought to account for close to 40% of all trades on European markets. We will discuss whether MiFID II is sufficiently well designed to meet these new challenges. Finally, you have Market Abuse Regulation and Market Abuse Directive II, which deal with market abuse. The European Commission felt compelled to amend its draft regulation and directive accordingly following the LIBOR scandal, right? Since benchmarks such as the LIBOR rate was not covered by the draft. So this amendment therefore completes the new market manipulation regime. The intention is to regulate the rules on insider dealing and market manipulation via directly applicable regulation, thereby denying the national legislatures any leeway during implementation and ensuring wide harmonization across Europe. The directive is set to contain criminal penalties for insider dealing and market manipulation, and we will discuss whether the new market abuse regime is appropriate in its amended version. So during the second panel discussion, we will therefore try to answer the following questions that you can read on the slides. What are the key strengths and weaknesses of these new regulations and updated directives? What is the likely overall impact of this new regulatory framework in terms of cost efficiency and transparency? What risks are there for unintended consequences? And finally, how we can assume that we get the details right. Well, I think we are all set. It's now time to give the floor to Tilman Luder, Head of Unit G4 Asset Management, DJ Market, European Commission, who will give us the Commission's point of view on the job done and the job that still needs to be done to better protect European investors. I thank you for your attention.